As people drift back in, I'm going to introduce you to the next panel discussion, which is titled Exploring Opportunities in a High Interest Rate Environment. Stay alive until 25. That was what investors and brokers were telling each other 12 months ago. The idea was that we would see 6 interest rate cuts in the US and in Europe, which would improve the investment environment over the next 12 months. Fast forward until today, and nothing has really materially changed. In the US, we only saw 3 cuts, and in the UK, we only saw 2 cuts. Yes, interest rates are a bit lower today, and the Bank of England cut their rate last week, but we're very far away from where we thought we would be at this point in time. And although corporate real estate investment volumes were up last year compared to the year before, investors increasingly fall into one or two camps. Wait for further interest rate cuts before we move, or not let interest rates dictate activity, but instead focus on where you are active. And today we're going to focus on the latter. For investors that have been sitting on the sidelines in 24, where should they look for investment opportunities in 25? Now, this is admittedly a very broad subject, so we're going to focus it to the alternative sector and on real estate and private debt. And to help me identify some of these opportunities today, I'm joined by Fabrice Fraikin, the managing partner and co-founder of Flexam Invest, Ian Worboys, CEO of EGLS, and our very own Mohammad Al Othman, head of alternative investments at Kamco Invest. Welcome, gentlemen.
Thank you.
And to the audience, we have limited time, unfortunately, so we can't take questions during the session, but if you have questions, and I'm sure you do, please do not be shy. Grab any of the panelists after the session and ask whatever you like. Right, Mohammed, I'm going to start with you. Question is straightforward. How has the higher interest rate environment influenced the investment opportunity set within the alternative space? And how has Kamco adjusted to it?
No, thank you, Hassan. مساكم الله بالخير جميعا. Good afternoon, everybody. We are in an ever-evolving world, similar to what our colleagues earlier and the panelists said in terms of the economists and what they've mentioned, that there are different circumstances that would rule the world, and it has been the case since the people started investing. There were a number of incidents that happened, whether it's from Brexit to COVID, that nobody has anticipated, but we got on with it and adjusted, and we started investing and looking the best opportunities to invest, and we've identified different opportunities back then, and we're looking at different opportunities right now. And to your point, to your question, Hassan, how the higher interest rate environment affected us, we've been investing in a certain way. Now, given where interest rates are, we have been looking at different ways to invest, whether we pivoted from equity, for example, in real estate, to more focusing on real estate debt, which have been beneficial to us and our investors. We've been looking at as well different products within the alternative space, whether it becomes, and I'm going to leave it to my panelists here, Fabrice, to talk a little bit about, which is leasing, which is an area that has been an area of interest to us, and we've been exploring it, and we are investing in it and providing it to our investors. So there are different, given we adjust to the circumstances, and we've done that, and inshallah we will continue to do so.
Very good. And in this environment, from your point of view, do you think you're still able to achieve solid returns in the alternatives market, or do you think investors need to temper their expectations?
No, there are very good returns in alternative space and the private markets. It depends on where you look at and what to invest and what kind of sectors. But there continue to be. And I understand, and we've seen the economists earlier on and their overview from all over the world. There are opportunities in our region, definitely, but there are also opportunities in the international markets. And they will continue to be. It just depends on which sectors that you actually focus on and look at.
And if I can just add a question there. We've talked previously today about tariffs and uncertainty that comes with it. There's a certain Trump effect on all investment markets today. What is your key takeaway from that in terms of changing circumstances? How do you adapt to that?
The good thing about the U.S. and what Mr. Trump and the President Trump has said in terms of tariffs, it's been said before. It's not something that hasn't been done before, and the use of tariff in markets and how we adjust to it and how aggressive he actually uses it or not, it has been used before. So we look at that, we assess it, and we do absolutely. There are good opportunities to be looked at and to take that into account and to assess the investment area.
Thank you. Now I'm going to turn to you, Ian, and talk a little bit about EGLS. So logistics alongside residential has been everybody's darling for the past 4 or 5 years. The logistics market seems to have gone from strength to strength. And I'd like to ask you a little bit about, so Mohammad mentioned changing circumstances. It comes with uncertainty. I think we're seeing the same thing in the logistics space from time to time. Occupiers change their plans. And how are you looking at that? And can you talk a little bit about how change affects the logistics market?
Yes, certainly. The logistic market, or as you say, sheds and beds, referred to
yes.
quite often. Sheds has been a popular sector in which to invest, mainly because after COVID, e-commerce grew so quickly during COVID as everyone got used to using their phones to order food, order their items, and not being able to travel to bricks and mortar properties. So the market benefited from that people suddenly understood what a warehouse is. Everyone drove past them and never thought that probably 95, maybe even 99% of what we wear comes from a warehouse. So the investment sector looked at it very favorably. There are less costs involved. You refurbish a warehouse over, say, an office building. So from an investor's point of view, it's a very solid investment, has long life. A warehouse built today should last at least 50 years. That's part of why EGLS, part of our policy is to buy older buildings and bring them up to standards for ESG. So from that point of view, the market is going to stay strong, and for the future will be strong. Some of the problems we've had is obviously yield movement, where values of warehouses in the last 3 years dropped by 25%, and that made the market more volatile, but equally it gives huge opportunity now to take advantage of correction as the market improves. And
I think I don't think I'm speaking out of term if I say that you've seen a few property cycles. So, do you see any difference of the cycle where we're coming out of or going into now versus previous cycles, and how have you seen the evolution of the logistics market in Europe since COVID?
Two things there. I think Hassan's trying to say that I'm at advanced years, having been through 6 recessions.
I didn't say that.
But I joined in 1981 on my first bit of sheds. And each of the recessions has had a different curve to it, a different bounce back afterwards, and how it's worked. This one, if you'd asked me 3 years ago, I was going to predict by now we'd be into a much better rise. But as always in real estate, there are hiccups along the way, as was COVID. It's a hiccup that we went through and we got over. The market, as I say, COVID, the benefit to COVID was people's understanding of warehouses, the growth of demand. And certainly e-commerce continues to grow. And I was in Dubai the last few days, and I was shocked when my daughter ran out of bread, and within 10 minutes, there was a loaf of bread on our doorstep. That shows how e-commerce is changing throughout the world.
And that, just touching upon that speed of sort of order to delivery, which that's really impressive. But can that speed be further enhanced in Europe, you think?
I think that the markets are benefiting from many things. Automation in picking in warehouses means you can actually deliver goods much faster to someone. I think the future of automated delivery is going to be a future which we're going to see a lot of as we go forward.
And so you're obviously the CEO of EGLS, European Green Logistics Space. Kamco recently took a majority stake in your business, and we're going to be working very closely going forward on unlocking the opportunities in that platform. You develop, you asset manage across Europe. Where do you know, the theme of the debate is the high interest rate environment. Looking at Europe today, where do you see the opportunity set for your sector?
I think there are various opportunities for the industrial sector at the moment. Development is one area where there's been a big drop in the amount of development done. For instance, in the UK, development starts are 60% down on 2022, 60%.
Wow.
And what that's doing means there's a lag from when we build, because it takes 12 months, say, to build a warehouse, 15, 18 with planning. And what's happening now is the occupiers in the market can see a big shortage in Europe in end of 25 into 26. There has been an increase in vacancy over the last year or so, but vacancy is on average only up to 5%. And pre-COVID, that would have been considered a very good, healthy vacancy and nothing to worry about, because it's been down at zero in many places. So now it is changing. But the opportunity is there for the market. And rental growth is the other thing that I think occupiers have suffered from, as they would say, from rental growth, but for investors it's been very good. We're now in a market where rental growth will not be as high, but it'll still grow. Although in certain geographies, in parts of Germany and parts of the UK, there'll still be continued rental growth due to the lack of availability and the lack of new buildings. So that development drives the whole process forward. And it's a reason why we're looking at refurbishing older 15, 20-year-old warehouses, repurposing them up to green standards. And that's both from a green perspective, very good that you're reutilizing something. And secondly, occupiers appreciate it because there's usually a slight rental difference to brand new.
And let me pick up on you mentioned green, and obviously ESG came up in the previous discussion as well, and sustainability has been sort of almost like a thread running through all the discussions today. Can you be sustainable, ESG friendly, whatever you want to call it, and still deliver returns?
It's a very good question, that, because ESG does cost, especially in Europe if you're putting solar panels on the roof, heat exchangers in the warehouses. But if you look at the world's biggest, or two biggest takers of space, which is DHL and Amazon, DHL have said that by 2030, all their warehouses should be green and friendly throughout the world. So they have to move out of older space and they have to take new space, or at least newly refurbished space. And again, that's an opportunity in the market when you've got the biggest mover and shaker actually doing that. It has an effect on the whole market because they are so large.
And that's, I suppose, speaks to staying close with tenants and understanding what's driving their decision making.
Very much. The tenants market dipped, but now already we talk with the main 7 users of logistics space across Europe, and they've all seen an uptake in Q4, and what they're predicting this quarter is an uptake. So so people are spending, and warehouse demand is increasing.
Very interesting, thank you. I'm going to go over to you, Fabrice, because we've just heard from the equity side of the investment universe represented through real estate. But I'd like to now turn to private debt, and just to give people an idea, the last few years we've seen a sort of stark dichotomy between within the European private debt market between robust investor appetite and strong returns on the one hand, and constraints in the origination from high inflation and interest rates on the other. AUM has moved in Europe from $271.5 billion in 2019 to 427 in 2023, according to Prequin. So clearly, it's a fast-growing market. Kamco has recently signed a partnership with Flexam for an asset leasing fund, as also Mohammad mentioned earlier. Can you perhaps please start by briefly explaining what asset leasing or finance is, and how does this create opportunities for Sharia-compliant investors in the high-yield environment?
Thank you very much. Thank you for inviting me, and I'm really excited and happy about this partnership with Kamco. Come back to your question, asset finance basically allows companies to acquire assets through leasing, enabling these companies to focus their capex on their operational costs. Flexam models focuses on mobile assets with a strong secondary market. So in case we have to repossess the asset, we can remarket it. So we do have a lot of investment into and our model as well make that the lessee, i.e. the company that leases the asset from us, has the obligation to purchase the asset at the end of the contract. So why is it a good investment to invest into asset-backed, asset-based, or leasing? Call it type of environment. There are two reasons for it. First, the lease rate increases with the interest rates. To give you an example, the lease rate of the same asset, like an helicopter, for instance, 2021, where rates were at 0, was about 9% per year. Last year, exactly the same asset had a lease rate of about 12.5%. So we follow the high rates environment. And the second aspect of why is that a good investment in this environment, it's a good hedge, or a good protection against inflation. High rates, as we all know, will bring more inflation in. And our collateral, which is the asset, will basically has more value across with inflation. And in case something happens, our collateral has more value, so protects the investor.
And just from the lessor's point of view, what is their benefit? What's the advantage? Why would they do that? Why not own your own helicopter?
From the lessor perspective, to own if you have to spend the cash to own your own helicopter, on the lessee side,
yes,
if they own their own helicopter, they have to spend the capex on it, and which means that they use most of their cash flows on that, and they don't have any remaining cash flows for the other type of operations.
Okay. And it sounds like risk features quite heavily in your space, and default risks or default rates is an obvious one. How do you manage that risk in the high-yielding environment or high interest rate environment?
I think it's true and correct to say that recently the default rate has increased. I think the peak was in 2024, where for the lower mid-market in which we are active, the default rate was about 2.5% in Europe. At Flexam, we have a weighted annual loss rate of about 15 bips, so much lower than what's on the market. And that can be explained by two reasons, I would say. The first one is if you think about default rate in Europe, the companies affected by default rate are companies with a high debt exposure and an incapacity of passing on the rising cost to their customers. So at Flexam, we will focus on companies with strong margin or companies that are able to pass on this inflationary cost to their customers. So we kind of protect it from this way. And the other aspect is we focus on assets with a strong secondary market. We call them liquid assets, which means that if anything happens to the company, because the asset is in one of our collateral, we can basically repossess the asset and remarket.
That makes sense. And in terms of the access, so I mentioned earlier that the pipeline of deals can be a challenge in a higher interest rate environment. How are you finding that and a sustained pipeline of opportunities?
Yeah, high rate environment you would expect that companies would tend to invest less, so the pipeline will be lower. However, because there's a couple of parameters, we, as I said before, we invest in strong margin companies, so they keep on investing. That's one aspect. The second aspect, in our business, when you invest into mobile assets, you have a lot of repeat business. So strong companies we've invested with in the past will continue investing with us. Some investment may be delayed, but still the investment is very strong. And as previously mentioned by the economist, the impact, the climate change impact is strong. And again, I said before, we focus on transportation assets, and the transportation sectors, which is about 20% of CO2 emission in the world, has committed for full carbon neutrality by 2050. So we've seen a lot of companies trying to basically change or renew their assets into something more green, more efficient. So that help us to basically have a pipeline that has been multiplied by more than 3 between 2018 to 2024. And our pipeline last year was roughly 9 billion euros of transactions.
9 billion?
Yes.
Very impressive. That's very, very impressive. Can I go back to you, Ian, with a question around risk? Because we have lots of aspiring logistics investors in our audience today. Sorry. What do you think are the key risks of investment in logistics in Europe today?
I would say that 2 or 3 things. One is not having the right expertise.
Yes.
That's a little plug for our company. But it is true. There are many people who are persuaded to invest in locations that maybe will give them a slightly higher return, but actually that return is because the risk is much higher. So I think having the right partner to know where to invest is very important. And I think having someone who's aligned with you makes it less risky when you look at things. I think some of the other bigger risks at the moment, obviously, are things like cost of delivery, which affects warehouses quite large. So being in the right location, be able to optimize delivery is hugely important. And that's why you've seen regional centers and the growth in urban logistics, something that we look at, so that the likes of Amazon, who want to deliver within 10 minutes, actually have local little hubs that have the most sold items within it. So I think that the other risk is being green, because if you have a warehouse where you have a tenant who feels your warehouse is not ESG or green, they will leave, and that can be an issue to people. So for a lot of landlords, they don't want the capex of putting in solar panels, putting in the various items that are required. Then again, that's an opportunity for EGLS.
Thank you. Mohammad, I'm going to come back to you as well with that similar question. From your point of view, having the purview across the alternative investment space, what are you looking more at risk? Are you looking at the fundamentals of investment? Are you focusing on those things increasingly in the environment today?
Yes, absolutely. Risk is a very integral part of our assessment in any opportunity or any sector that we look at. We try to mitigate that by partnering with the right partners and working with the right people in the areas that we are trying to explore. But also, I want to focus and also mention that diversification is key across asset classes and across sectors. It's very important because we are currently, when we talk about public markets and private markets, public markets are at a high level right now. Private markets are very in the other way. So it's an opportune time to get into the private market compared to the public, but I'm not saying that you shouldn't be investing in public markets. There should be diversification, there should be allocation to public markets and fixed income, but also have probably a little bit more given where the cycle is today in the private market. So diversification is key. I always a believer of that, and I think that will help mitigate risk.
Thank you. I'm going to finish off with the last question for each of you. And I'm going to give you a couple of minutes each to answer. If you had $100 million today, where would you put your money?
You're going to start by me.
You can start.
Thank you.
You can start.
I guess I'm probably going to be quite boring by saying, first of all, I will invest in what I'm doing, i.e. my strategy to start off. But more generally, I would say that, as Mohammad just said, I believe in diversification. And I think to invest in diversified portfolio of asset classes and durations would be quite key to preserve and have good performance on this portfolio. But private equity, hedge fund, private debt, real estate, and probably a bit of philanthropy as well would be my key asset classes. And I would privilege private markets more than liquid markets, but that's my personal point of view.
Thank you. Ian?
Well, I'd like to thank Kamco for giving me 100 million. I presume you're paying that.
Yes.
But I think for me to be able to invest in development at this stage of the property cycle, I think that development is low risk if you're in the right location. And I think the opportunity of when you finish your product now in 2026, you're going to be able to see rental growth and great income. Obviously, interest rates are holding off development a little bit because people might put their money into fixed income. But I think as you look forward, the logistics market is only going to grow. A quick figure for you. E-commerce, every time there is 1 billion of spending from e-commerce, you need 100,000 square meters. There's a research company, Forrester, who say at the moment the e-commerce value in Europe for the top 5 countries is 389 billion. And by 29, that's going to grow to 565 billion. If you work that out, that means that already in the predictions, we're 17.5 million square meters short of warehouse for the future. So that growth and people's desire to buy through their mobile phones is only going to grow. The UK is at 23%. But if you look at France, Germany, Spain, Italy, they're all around 14%. And that's going to grow. So again, thank you for the money.
You're doubling down on your...
I'm doubling down, definitely doubling down.
Mohammad?
That's a good question and tough question to answer, but obviously on some of the themes that we've done and we are doing, logistics development is definitely an area that we actually believe in. And there is so much demand, as Ian has mentioned, whether it's in Europe or we can see that in our region as well, that there is demand that is coming, but it needs to be built in the right way. That's an area of interest for us, and we will continue to deploy in that. Asset-backed leasing that provides the income and the yield is definitely an area that we are investing in. But I will also mention the opportunity that is in the region currently and the region that is benefiting of the hype, specifically in markets like Saudi and the UAE. And when it comes to tech companies in our region that are looking to be listed, that's an area also of we think, we believe in it and we actually are investing in it, and we encourage, we provide it to our clients to also to look at. Public markets in our region as well are doing well, and we think that they will continue to do well in 25 and beyond. So those are, I would think, those are the main areas that we would be investing in.
Thank you. Right, we are running low on time, so I want to give a big thank you to the panelists. I'm reassured that I randomly selected panelists, and they all confirmed to me that there are still investment opportunities in the current market. I think it sounds to me that we're looking more at fundamentals. Downside risk management is important from what I've been hearing, but the opportunities are there. I think logistics, Ian, what you're inferring is back to fundamentals, location. So that's reassuring. I think, on a personal note, I think change is the new normal, and we need to be prepared to always face change in our investment strategies and decisions. And to use a term that I've heard recently from the market, stay in the mix until 26. Thank you.